Hey everybody, it's Seth and Paul with Everything Money Channel. Today, Paul talks the ins and outs, goes over the 8 pillars of the Apple stock. Is it affordable? Is it for you? What do they make? What's their income? What's their balance sheet? What's their PE? All of these crazy terms you have no idea. You're going to learn right now on the Everything Money Channel through our Yoda. Paul.
Who's Yoda?
Who's Yoda? Oh my God, he hasn't watched Star Wars. We'll find out more on this episode. Watch it now. Hey guys, it's Seth and Paul for the Everything Money Channel. Today, Paul talks about Apple. The stock is, I love Apple stock. I've owned it for a while. I recently sold, as you know. I had a few shares a long time ago, but tell me what you love, hate. Tell me everything about this Apple stock and what's going on.
All right, so Apple's in the news a lot because they're doing a 4-for-1 stock split. So if you guys see right now, the stock price is roughly $4.40. If that stock split happened today, 4-for-1, Seth, what would the stock price go to?
$4.10. 110, sorry, 110.
110, correct.
Yeah.
Now, the one thing I want everybody to keep in mind, if you watched our last video on stock splits, which if you didn't, go back and watch it. This number, if it were to stock split today, the market cap would not change.
Okay, right. I get you. 'Cause the market cap is currently what?
$1.9 trillion.
$1.9 trillion. Boy, they're doing good. I own like 17 Apple devices. I think I have 4 iPads, Paul, for no reason at all. I just buy them and throw them out after one-time use. So you're saying the market cap does not change because, tell me why.
What's going to happen is the stock's going to go down from 440
to 110.
to 110, but the number of shares are going to go up from X to 4X.
4X.
So it's going to grow 4 times larger to account for the 4 times drop in the price.
So in layman's
the
terms,
market cap will be the same.
If I have 1 share at 440, I will in a week perhaps have 4 shares at 110.
Correct.
I have the same amount of money invested in the company, except the shares are lower in not lower in value, just kind of how do you describe it?
1 share at 440 is the same as 4 shares at 110, correct?
And reaffirm why companies do this, Paul, real quick.
These companies only do it in order psychologically to get people to think they're going to afford more shares.
It absolutely sounds more affordable, quote unquote.
Exactly. But all this is just telling you, hey, people out there, instead of you had $500 before you could buy 1 share, now you're going to feel so much better because you're going to buy almost 5 shares. It makes people feel like they're buying more of a company.
That's great. It works on me.
There's a very successful person we know who once said to us, I can't spend percentage points. I can only spend dollars. So to him, buying this made much more sense than buying this. Makes no sense whatsoever, but in his head, and this is a very successful millionaire. Hey, do you have any pictures of you when you were a kid?
Speaking of, that is a great. Right now, I'm going to put a photo of myself, most likely in a baseball uniform, on the picture, on the frame right now. Boom. There's no way you can't like this photo. I'm telling you right now, look at this kid. He's fat, he's chubby, no girls liked him, and he was born to be a podcast host with Paul Gabriel. Smash that like button right now.
And now he has a beautiful wife.
She's stunning, Paul. Have you seen her lately? Oh my goodness, she's incredible.
Have you been ravenous?
Smash that like button right now. Pretty please for the YouTube algorithm. Press that thumbs up. Thank you so much, Paul. Keep going.
So
nice lead in, by the way, Paul.
You
are smashing it today.
I'm trying to be a host.
Look at you go.
We're trying to kick you off the podcast.
Yeah, I was gonna say it should be the Paul show later on after today. So go ahead, Paul.
So Apple has been one of the highest flying companies for a long time. I mean, look at the stock price right here. In 2010, it was roughly, what is that even?
I think I bought, Paul, at about 20. That might be when I bought, 2010. Because remember, Paul, the advice from one of my friends at work was buy stocks that you really like.
Yeah, why does that not work?
Because, should we go into it?
Yeah, this is part of the whole Apple thing.
Oh,
but it's
okay. Yeah, so I bought Apple stock because my friend told me if you like the company, just buy it. But at the time, I think a lot...
which makes sense to a certain level, because your comment is, if you like the company, a lot of other people probably like the company and the products. Therefore, people will continue buying. Their revenue will go higher, the profit will go higher, the stock will go higher.
I certainly did not look at any balance sheets, any cash flow, anything. It just went on. I like Apple products, Apple computers, and so I bought maybe 20 shares back then. And at that price for sure. And I recently sold because it had gone up, whatever percentage that is, 90-something percent.
Oh, no, way more than that.
Way more than that?
Yeah. So This is off of Peter Lynch's book. Peter Lynch is one of the best investors ever. He always said, buy stock in companies that you love. But what they don't remember is the next step is make sure they're valued fairly. So what people do is they sit there and say, oh, I love Tesla. It's a great car. Let me go buy the stock. But they have no idea what's behind the company. There's somebody who I've worked with who loves Apple. Like literally he day trades Apple all the time. He once emailed me 3 or 4 years ago and said, Paul, from a fundamental standpoint, a value investor standpoint, how does Apple look? At the time, phenomenal. They were selling for 15 times earnings, which is low. They were growing like crazy. And I said to him, he's like, well, why don't you buy? The only concern I have is, can they continue this going forward? Because tech companies are very fickle. What's killing it today might not kill it. People gotta remember, 20 years ago, Apple was pretty much bankrupt.
Oh, okay.
Like they were on the cusp of bankruptcy. They brought Steve Jobs back. He turned everything around. I mean, if you look at the company, it was selling for nothing.
In 1999, I moved into college with 30 other people in a house, and one artistic weirdo had an iMac.
Oh yeah, remember how weird those computers were?
Yes,
they
had
the clear
different
ones
colors.
that were all together, and
they had a handle on top.
It was stupid.
Yes, it was stupid.
I remember making fun of another teacher at our high school who was a total tool, but because he was like all in love with the iMac. He's like, it's just a better value than everything. I'm like, you're an idiot. And that was 1996, 1997 as well. When we're looking at Apple, our key then is immediately go to the financial statements like we've done before, right? So here I am on the annual statement going back 10 years for Apple, the profit and loss statement. All right. What are the things we look at? There are 8 things we look at in a stock, right?
Go ahead.
First thing, revenue growth. In 2010, what did Apple do in revenue?
Tell me, I can't see.
$65 billion.
Okay.
Then they did 108, 156, 171, 182, 233, a little dip, 216, 230, 265, a little dip, 260.
Wow.
But it's very consistent growth, right? Okay, that's the first thing we look at. Second thing we look at, profit growth. Here is the profit. 2010, 14 billion, 26 billion, 42 billion, 37, 40, 53, 46, 48, almost 60, 55. So very consistent growth. As their revenue goes up, their profit's going up. Are there fluctuations year to year? Yeah, that's fine. For such a big company, I'm okay with that. So I'm looking at this saying the first 2 things we need, we got right here. Apple's growing like crazy. I mean, I would have thought in 2010 that they were pretty close to their maximum level of revenue. And since then, they've gone up over exactly 4 times more.
What are a couple turnoffs with your first 2 pillars? What are a couple turnoffs that can occur with other companies if revenue grows and profit does not? I would assume
that's a big thing because you got to sit there. If revenue is growing and profit's not, you got to wonder: is there a manipulation going on? Why are they growing revenue, not growing profit? They're not adding to the bottom line. That doesn't make any sense. They should be able to clip away at that. Now, it also depends on the stage of the company. If it's a big company like this, that's a big problem.
Okay.
A lot of other times when you see big jumps in specific income expense items, you don't want that. Like if interest expense skyrockets because they took on a lot of debt, we don't want that.
Talk about pillar number 3.
So pillar number 3 is, I have to look, free cash flow growth. Okay. So everyone, free cash flow, if you remember, is you take our cash from operations, which is right here on the balance sheet, and you subtract out your net change in capital expenditures. So in 2010, it was roughly $16.5 billion, then $30 billion, then $41 billion, then $44 billion, and all the way here, it's up to $60 billion. That's free cash flow. What's free cash flow? That's the money that the companies use after they pay for their capital expenditures, which is their investment back in the business, and they can use it to acquire more users, pay out dividends, buy stock back, things like that. Take the cash to reward their investors. In a company as big as this, it's going to be hard to reinvest that cash at a good rate of return. So sometimes the best way is to decrease the number of shares outstanding so that the owners can get more share of their profit, or just give the money back in dividends to their investors. It's a great thing for the investors to be able to get back if they can't invest the money at high rates of return. With such large amounts of capital, $60 billion, $50 billion, it's really hard to invest that at a reasonable rate of return.
Okay, what's the next pillar?
Okay, the next one is decreasing or steady share count. So if you remember, if the company
decreasing or steady share count.
So what a lot of companies will do sometimes is they'll make an acquisition, but instead of paying cash, they'll issue more shares
They just make them up?
They just make more shares.
Uh-oh, that's not good. Not good for
Well,
the
it's not good because here's why it's not good.
Mm-hmm.
If you have a company that makes $10 in profit and you have 10 shares, how much is that per share?
$1 a share.
$1 a share. If all of a sudden they have to make an acquisition and they have to increase that to 15 shares, how much? They still made $10 a share, but now they have 15 shares. So now you're only making the same share that you owned, instead of getting $1, is now only getting 67 cents per share. That's not a good thing. So you want to see a company that's either staying steady or decreasing the number of shares. That way the existing owners, to me, that's a sign they care about the existing owners. Hey, we're not going to what's called dilute you. We're not going to issue more shares and make your shares worth less money.
This is kind of like the same thing they're doing when they print more dollar bills as they dilute the market.
Yeah,
let's not get into that.
Let's not get into that conversation.
That's another podcast. What's the next pillar, Paul?
Well, let's make sure we have to look at Apple first.
Keep going.
In 2010, Apple had 6.4 billion shares. Now they have 4.6. Yeah, so they're taking it down almost a third. 30% drop in the number of shares. That means every share that was existed in 2010, if you bought a share in 2010, you actually get 30% more of the cash flow, profit, everything the company has, you get 30% more of just by owning that share. So that alone, if the companies were worth the same amount of money, you got 30% more value just from that. That's
Amazing.
pretty awesome.
Yeah.
All right, next pillar. Price to earnings ratio less than 20. So remember what a price to earnings ratio is, right?
This is the PE ratio.
Yes, that's PE ratio. Tap the blue one.
PE ratio.
We want PE ratio.
Less than 15.
Well, the historical average is 15, but I sit there and say, give me less than 20, because I want to be able to see if it can justify a higher PE. Like, oh, is it growing fast like Apple is? Things like that. Because if it's growing,
what's the quick way to remember what a PE, like that number means? 15 is?
So it's 15 times the earnings. So if the company makes $1 per share, you'd be paying $15 per share for the company. But if you look at the total, it's the profit multiplied by that 20. So take the profit of the per year, multiply by 20, and the market cap should be less than that.
Okay.
On a per share basis, take the per share profit multiplied by 20, it should be less than that. Or, very easily, every website have it. It's one of the most common things out there.
PE.
Uh-oh.
What is it?
34.
A little high, Paul.
Very high. Very high for me. And I look at it going, okay, I'll still run it in my model and see if it can justify it, but I really doubt it can justify it for paying over double what the historical average is. And my comment is, how likely is it that Apple goes from $260 billion in revenue and still continues to grow the same way it did in the last 10 years? It's grown 4 times in this last 10 years. What are the chances that if it grows the same 4 times, it would have to do $1 trillion in revenue in 2030? Is it possible? Sure. Is it probable? The way people get into trouble in investing is they start confusing what's possible and probable. They get so in love with a company, they sit there and say, this company's unstoppable. They're going to grow like crazy. Maybe. Can very well happen. But right now, the biggest companies out there is Walmart, and it does $550, $600 billion a year in revenue, and they've got 10,000 locations or whatever the number is. It's going to be very difficult. So you got to look at these things and say, is there potential if the world gets richer and a lot of people start using products? Of course it's possible, but it's not probable. And that's always a concern of mine.
Isn't this PE number, it seems like this is really what stops you a lot of times. Can you go straight to this number at times and just say, like, this is not?
You can. And that's what I usually probably do. I'd usually go to this PE number and say, okay, is it some astronomical? But the thing is, I still want to see the financials. And the reason being is, if they had a really bad year last year where they had to write down something, that could skew this PE number very quickly for no reason whatsoever.
Okay.
Does that make sense? So like, let's say, for example, they had to write off a $10 billion acquisition. That could make this PE, if the company makes $10 billion in a year, it can make or $20 billion in 1 year, it can make the PE double for no reason whatsoever. I'd rather look at the financials first and see, is it consistently growing and those kind of things, and then go from there to see what are these ratios.
Now, I think from what you've taught me in our past videos is the PE ratio, is this like pretty much like how over or undervalued it is?
It's one of the metrics you use. The 8 metrics we have that we talk about, the 8 pillars, those are the kind of things you look at the whole picture. Very rarely you're going to have a company hit all 8. In fact, I don't remember the last time I saw a company hit all 8. But the whole point is, it's just like when you get married. It's not like Beth was perfect. It was, hey, she hits when I'm around her, there's things that she does that annoy me, but I can't have everything, so I'm going to settle.
She still puts the toilet paper on backwards.
Come on.
After all these years. I even told her the trick, if it hangs off the front, it's like like bangs are good, mullet is bad, right? So envision this, folks. If the toilet paper's hanging off the back, mullet is bad, bangs are good if you're watching on YouTube.
Business in the front, party in the back, or something like that.
Yeah, but she can't figure it out. But God, I love her. Keep going, Paul.
Exactly. So, but she's not perfect, but you still love her. All right, so another thing we look at, total current assets greater than total current liabilities. So what this is, and if you've watched our Boeing video or all their stocks we've ever done, and you should look at those, it's what's their total cash and inventory on hand versus how much they currently owe on all their debts, on the current ones. That's everything due within the next year.
Okay.
Not the long-term debt, not leases, not loans, not big loans.
Mortgages.
Just, payables, things that are due very quickly.
I always bring this back to the personal side. Like, how much money do I have in the bank versus how much I owe on my credit cards, not so much my house, right?
It's how much you owe, like, on your utility bills, your rent, right? That not how much you owe on your mortgage or your car, or your car note. Like the total balance in your car. Okay. Correct. We always talked about that before.
Okay.
So you go to the balance sheet, and we look it up. So right now, total current assets for our friends at Apple, $163 billion. That's cash, inventory, receivables. They have $163 billion of cash and money that can be converted to cash very quickly. That's a lot. Total current liabilities, 105. So they got plenty. They got $57 billion in extra money sitting there that they can work with. So there's no concern, are they going to pay their bills this month? Are they going to pay their bills this year? It's pretty much, hey, they're safe right now.
So this would be a safe investment.
It would be safe in the sense of, from a balance sheet perspective, it's very unlikely that Apple goes under.
Is one of your pillars just maybe a little bit going back to like everyone freaking loves this company? I mean, how are the workers so damn happy?
So that is
no one's drinking the Microsoft Kool-Aid. It's always...
Oh, a lot of people are drinking the Microsoft Kool-Aid.
Oh, really?
That's the thing. When I bought Microsoft, when nobody was... Like, when I bought Microsoft in 2011 or 12, I literally had a tech guy say to me, I wouldn't buy Microsoft for $50 billion if there was $100 billion in the bank, and I'd take my money, get my $50 billion back, and double my money.
Yeah.
That's the idea. But the great news is, Seth, when companies are at that stage, that's where it's hard. You have to find companies that are not sexy for investors, but are still growing and doing great things.
Well, I hear you. Of course you do. But I mean, that's the saying, right? Don't drink the Apple Kool-Aid. But I mean, like...
Well, drink the Apple Kool-Aid, but just look at the company and the...
Does any of that go into your mind? The fact that you go into an Apple store and it looks like a Cedar Point, you go into a Microsoft store and there's nobody there? I mean...
Well, they're shutting down the Microsoft stores now.
Of course they are.
But if you look at Microsoft's revenue and profit, it's...
That's why you like Microsoft
growing
much better than Apple, right?
Well, then I have to look at the valuation level. I actually think Microsoft's more expensive than Apple from a perspective of PE and cash flow and things like that.
Okay, so go back to this.
Of course, you need to look at the company and make sure it's going to be a company that's going to be around. But you'll see a lot of that based on... Don't get yourself... I'd rather have you be more cynical of that than go buy it just because it's very sexy. So, another pillar. The final one, not the final one. Profit margin. I like to see a profit margin. I do like to see a profit margin that is over 10% for the bottom line. Now, Apple should have a much higher profit margin. Tech companies, software especially, have higher profit margins. Their profit margin last quarter, 19%. Their gross margin, 38%. What's the difference? Gross margin is for every extra product they sell, they make 38% of that revenue as profit to the bottom line.
Wow.
And they pay their overhead, their costs, their employees, all that stuff. The bottom line, after taxes, they're at 19%. That's solid. After taxes, every dollar they bring in revenue, they put in their pockets 19 cents of that.
What's this number look like for a bad company? A not so...
I don't like to see it below 10. Does it exist out there? Of course it exists out there. Are there good companies that have less than 10? Yes. But if I do see that, I want to understand how the company makes money and how they pay their bills and what their ongoing fixed costs are.
And this number for like Tesla?
Oh, well, Tesla doesn't make any money. Well, actually, they made money the last 3 quarters, but it's very low.
Okay.
It's very, very low. I'd have to look it up, but I'm happy with this. So another pillar hit. So far, we've done 7 pillars. Only one hasn't hit. That's the PE.
PE, yeah.
The final one, price to free cash flow less than 15. So I like the price to free cash flow more than the PE ratio.
Oh, okay.
Because what the price to free cash flow tells me is the actual cash coming in.
What I like even more than that, Paul, is this video. Please smash that like button right now. Little thumbs up right below. And keep going, Paul. Please smash that like up. Love you guys.
So I always tell people the net income number can be manipulated. It has a lot of things like depreciation there, writing off this and that. A lot of things can be faked. On the free cash flow, it's hard to fake that because it's counting the money that comes in and the money that goes out. So free cash flow, if you remember, was the cash from operations. Oh, sorry, not balance sheet, cash flow. Is the cash from operations less the capital expenditures. So 70 minus 10, $60 billion. I want it to be less than 15. So what's 60 billion times 15? $900 billion. 900. So I want the company to be worth less than $900 billion. What's it worth?
1 point something trill.
1.9 trillion. So it's basically 30 times free cash flow. So on the two major valuation metrics in our pillars, it doesn't hit either one. And the good news is they're pretty similar. One's 31, one's 33. And over the long haul, net income and free cash flow should equate out.
What price do you love buying this stock at?
I would buy the stock at today before the split under 250.
Paul, that's drastically different.
It wasn't. Well, let me tell you something.
Okay.
In the last year, here's 250 right here.
Oh, wait, what is that? April?
Here's 250 right here.
Oh, okay, I see.
It's been under 250 a couple times.
Holy shit! Look at that.
In the last year. So you sit there and see 430, 440, but look at this run up since April. It was 240 in April.
That wasn't that long ago.
It wasn't that long ago.
Wow.
Yeah. Now, the reason I didn't buy is I still believe, my personal opinion, and this is not what you should do out there. My personal opinion is I think there's a big downturn at some point that's going to happen, and I think Apple, as one of the big leaders in the run-up, will be the ones hurt the most. So I want to be able to buy Apple at a much lower price. Maybe when the PE is 12 or 13, because people are like, oh, tech's not growing, it sucks, this is awful, and that will happen. And there'll be a time when Apple is considered a dead company. It's just going to happen. It happens to every great company. You can't tell me a company that 50 years ago was a dominant leader and today is still a dominant leader. Look at GE, it's practically bankrupt now. Microsoft 20 years ago was untouchable. And then 10 years later, it was considered dead. So we have to sit there, and my point is Apple's on my radar because I want to own Apple. I just got to wait for the price. Because of all the 8 pillars, 2 of them are based on actual valuation metrics, ratios, and they both failed that test. So it's pretty much an automatic no for me at that standpoint. That's a no for me, dog.
At this price.
At this price.
Thank you, Randy.
Yeah.
If you enjoyed what you see, smash the like button. Follow all our videos. For more of Paul, for more of me, follow the Everything Money channel. Paul, thank you for your insight on Apple. See you guys. Love you.